Okay, I think we're ready to go live. The time's changed in the UK, so I'm not sure if a lot of people realize the time has changed in the US, like relative to the US. I'm not sure if that makes a huge difference. Anyway, we're going to talk about how to invest, episode 9. The idea of this that I do every Friday at 9 a.m. Eastern time is we talk about investing. So I kind of some of the things that I notice in the markets over the past week, and generally some kind of evergreen topics that we talk about. But typically we talk about just things that are kind of to help you think about investing, and things that I find quite interesting as well. Just how to think about investing from a perspective of a value investor, what it means to be a growth investor, and so those are some of the things that I kind of wanted to talk about. Someone wrote to me and asked me, hey, hello, good morning, Taylor. Someone wrote to me and asked me, Michael, can you please put on a shirt and can you comb your hair? And I really wanted to do, but I just got too busy. I was working too hard and I essentially didn't have enough time. But hopefully next Friday, it's not going to be so charged, the earnings seasons, and I can get through and be able to do those things like talk slower, smile, and do my hair, and etc. So here are some of the things I want to talk about. So just before we get into the bulk of this, if there are questions that interest you, please write to me beforehand, because as someone said to me, it's kind of difficult for me to kind of give you enough analysis on the go. Sometimes it's quite difficult for me, and I kind of would prefer to give you a more rounded explanation rather than me just kind of take everything on the go. Okay, so I don't know if you guys have been following the markets in the last several days, but there's this kind of large, the market's been very, very volatile. So you see certain stocks like Peloton last night that kind of just marginally miss expectations, and they're just getting absolutely destroyed. And you see this kind of Nvidia and Tesla and some other businesses that kind of, they're difficult to describe. Yeah, they're doing great things, but I mean, at some point, those valuations just get really, really stretched out. And I mean, I can make an argument for Nvidia, and great business, but it's just difficult to kind of get a sense of this. The other one that I often talk about is Cloudflare. Cloudflare reported results last night. I didn't have a chance to go through them. But I mean, the stock is really expensive, and I just find it so difficult to kind of make a case for it. I know that a lot of people watching this will probably be Cloudflare shareholders, and they'll kind of say, oh, Michael, you don't understand how innovative they are and this and that. But I mean, you're paying 68 times forward sales. That's a really heavy premium. That implies that if you look forward over the next 68 years, if they grow at this consistent rate for 68 years, there's your valuation, kind of the multiple that you're paying. I used to think that stocks priced at 30 times forward sales was expensive. Man, when you look at something like Cloudflare at 70 times, it's just really, really expensive. One of the things I wanted to highlight, so I'm just reading this book by Ed Thorpe, A Man for Any Market, I think it's called, or something like that. And it's just so interesting to see a few things. The first thing is that this idea that the stock market is about putting odds and trying to bet on them, but that everyone else's odds impact your odds. So it's not the same, for example, with, let's say, blackjack. And blackjack, you are just you have certain quantifiable, to a certain extent, quantifiable probabilities, but it doesn't really matter too much what someone else makes a bet. Whereas in the stock market, how other people bet really dramatically changes quite rapidly the whole thesis quite considerably. One of the things that I find quite interesting that I've seen right now is this whole ad tech space. Everyone might know that I'm digital apps shareholder, and the stock, I felt that the results were really okay, and the stock plummeted like 19% on the next day. And it's just quite interesting to see this whole sentiment. So on the back of that, I haven't had time to go through, but Magnite also reported their results, and the stock just got utterly crushed. And it's just interesting to see these businesses, there's a whole sentiment change. So if you look back to 2020, everyone was very, very bullish on this ad tech space. This was obviously led by the trade desk, but they were the leaders, the kind of lead in this space. And within that, everyone just kind of became a Me Too opportunity as well. So, for example, there's the Digital Turbine, there's Pamatic, there is Parion, there's Magnite, and it's quite interesting to see that as the boat lifted all the tide there, now in 2021, the market is just saying, no, we don't want anything to do with this kind of business, and the multiples are really rapidly compressing, and it's quite difficult to justify how things will unfold from here. It's difficult because it's really an environment that I'm not very familiar with. So typically you don't see the multiples compressing at such a rate as they are right now. So someone asking if the stock plummeting is normal or irrational. So I don't know, is a short answer. But when you look back to around February, March time of 2020, things were just really, really volatile, and just it was coming down overall, but it was just up and down a lot. And once we hit around about kind of April time, May time of 2020, everything was very, very smooth, going up and up and up into November. And it was just so smooth. Everything was kind of smooth, and then it culminated in February of 2021, and then things then sold off again. Very, very. The convergence was very, very tight. And now I've noticed that since the summer, the market has been really weird, because I have had this idea that the safest assets were getting repriced meaningfully higher, possibly even unjustifiably so, whereas assets that the market wasn't really 100% sure about their staying power over the next 2-3 years were getting really, really compressed down. And you can see this probably in your value stocks. If you kind of hold any like low growth value stocks, you will see that the market is just discrediting those, and things that have the narrative that they're rapidly expanding their opportunity and taking market share, the market is paying really, really high prices for them. And it's quite difficult, I think, in this time to find interesting opportunities that everyone hasn't already come through before already. And for example, I'll give you an example. So in the case of, let's say, Teladoc is a business that does healthcare, and if you look to 2020, everyone was really excited about how healthcare was going to disrupt the whole healthcare system in the US, and that it was well overdue for a disruption there. And then they made the acquisition of Livongo, and then since February, the market hasn't really wanted much to do with it. And they just, when they reported their results, I think it was last week now, they put out their guidance, which is quite abnormal, but they put out their guidance all the way for 2022. And they say they're going to be growing at approximately 28% compounded annual growth rate. So it was essentially saying to the market, okay, we still have a long runway ahead. Yes, we are comping the large acquisition that we made, but what they're saying is, okay, we've seen that the multiple is compressing significantly. We want to give you confidence that our business has staying power, and the market is just, it's a very difficult market right now. And I think that these type of businesses where you're kind of taking a contrarian view and you're saying, okay, I don't mind paying, let's say, 8 times sales for a business that is growing approximately 30%. I think that's, but you haven't had that really difficult stamina to take that position and hold it throughout all that volatility. And it's a very difficult market right now. The other thing that I find quite interesting is just this whole COVID trade unwinding. I have a couple of positions myself. I have this dog company, Chewy, I think they changed the name to, no, sorry, Bark, I think that's, sorry, Chewy is the competitor, sorry, Bark. And it's alongside is this whole COVID trade, like Pinterest and everything. The market is just saying, okay, those were COVID winners, and irrespective of their potential, we're just dumping the stock. And Pinterest reported last night. I haven't had time to go through their results yet, but what I read on the face of it is that engagement is better than people had originally felt it was going to be. And there's this kind of market is kind of punishing so many of these stocks, and it's an interesting time. And I know that a lot of people say that that's because there's a lot of new traders in the stock market that weren't present before, and everyone is much more short-term oriented, and that seems to be the case. I think that yes, as you see this kind of this enthusiasm for things that are going up, and as long as they're going up, everyone believes that they're going up to the moon. And if you can make, let's say, 500% in a year, that's what you should be aiming for. And if they're not going to make 500%, you just dump in the stock irrespective of the underlying business. And it's very unfamiliar to me. I mean, it's definitely new territory to a lot of investors. The one point that I probably would look back towards is really about the back end of 2018, the fourth quarter there, when there was a whole kind of whether Trump was going to have some kind of issues with China or not, and that was really a lot of volatility then. And then after that period in 2018, things were really, really smooth once again. And right now, things have just really unloaded. And I think that, I don't know if it's because a lot of people are buying ETFs, or I'm not very familiar with what's happening. I just can see that underlying businesses are relatively healthy relative to expectations. A lot of these growth businesses are actually doing reasonably okay from what I see. They, easily meeting or surpassing the estimates that were put for them. But it's the underlying market security itself that is very, very volatile. So anyway. One of the things that I wanted to just talk about along this way is about the idea. Everyone says, it's worthwhile paying a very high multiple for a business that is growing very, very fast. But what happens is when that growth rate starts to slow down, the multiple compression happens very, very quickly. The change on sentiment is very, very quick. And you're paying, let's say, the multiple, let's say, 22, 23 times forward sales for a business that is growing approximately 30%, you think that's okay, and then the business starts to kind of grow at 25%, and the multiple doesn't proportionally come down, but there's a really kind of step down to like 15 times forward sales. And that's just kind of, it's very, very difficult as a shareholder of a business, unless you have a lot of conviction in that behind that name, and unless you've done a bit of due diligence on that name, it's very difficult to remain a shareholder. And someone wrote to me the other day and said, Michael, I think that a very good way to go about this is when the stock falls dramatically, relative to how big a position it is in your portfolio, that reflects the amount of time you should spend reading about it when it falls. When the stock is down, let's say 15-20%, you want to go back to basics, and you want to try and figure out really what is the staying power of that business over the next 3 or 4 years. One of the things that I look at is try to find businesses that are relatively stable and kind of growing, because the choppy businesses that are very volatile, like one quarter they're very strong, next quarter they're not so very strong, you're going to have more difficulty in handicapping those. Like, this is just for educational purposes. This is just a stock that I own. This is not investment advice, but there is a stock that I do own, and they just reported last night, which is GoPro. GoPro has very, very choppy revenue growth rates, and you can see that the market wants nothing to do this. So the market cap is approximately 1.6 billion, and you can see that it's just the growth rates are really just so unpredictable. And in this event, it's a stock that I own, and it's priced at approximately 8 times free cash flow. This year's 2021 free cash flow. And I just think to myself, okay, this is cheap, but the market doesn't seem to be that interested in about it. Yes, it has rallied a little bit in the pre-market, but it's just incredibly cheap. And I don't see many businesses out there that are growing, profitable, with balance sheets that are very, very strong, priced at 8 times free cash flow. And I just kind of find myself, it's so difficult, this market, because as long as the businesses, everyone wants those compounders, those businesses that are very, very much growing each quarter sequentially and year over year, and people are paying a very, very large multiple for that, and things that are kind of slightly more, you need to kind of understand a bit more, people just don't want to get involved with that. So I think that's very, very interesting. And I just wanted to mention one more thing before I kind of hopefully get some more questions through. I was reading this paper by Apollo Asset Management, and they talk about how over long periods of times that value has done particularly well, but you can see that in the last 5 years there's no questions that growth has been really a leading way to invest. Now, over time, over very long periods of time, it's been shown without a doubt that value does better than growth, and value does the reason why value does so well is because you have these businesses that are kind of ticking along and growing, but the multiple that people are willing to pay typically expands. Whereas with the growth stocks, within those growth stocks, many of these businesses are growing really, really fast, but they're substantially unprofitable to start with. A portion of those businesses will go on to do great things. Many of them will not do anything, but you're paying a very large multiple for most of them, irrespective, because they're growing so strongly and they're highly unprofitable to start with. And it's only much later that you get a sense for what was worthwhile paying for, and you go for when things kind of in the past 5 years look like growth is the leading way to invest. It's kind of very difficult to know whether that's going to be the same over the next 5 years, because historically value has been a much stronger investment strategy. So it's very, very difficult to know how things will go from here. But as it stands right now, I'm inclined to believe that growth investing probably is a better way to invest, but it's very difficult to know. That's why I kind of split the portfolio, and I kind of have this what I call the hybrid portfolio, which is kind of half of them kind of being growth stocks and the other half being value stocks, because it's very, very difficult to know how things will go over time. If given a choice, would you invest in Tesla or NIO? I mean, I have no idea about investing in either of those. It's so difficult. For so long, investors have been saying that Tesla was overvalued, and for so long, investors have been wrong. So it's just impossible to know. What I will say is I can't imagine that Tesla will do another 3,000% over the next 10 years. I can't imagine that. I mean, I haven't been imagining that for a long time, but Tesla is right now on the cusp of being probably within the top 4, top 5 biggest companies in the world, so already 1 trillion market cap, and I can't imagine that it's going to grow another 3,000%. But I've been saying that for so many years now, and every year goes up another 500 or 1,000%, so I have absolutely no idea. But for you as an investor, you don't have to make that decision, right? So there are other, let's say, 4,500 stocks to pick out there. You don't have to try and pick between the 2 of the most followed stocks in the world. So that's the great thing about investing. You just have to kind of try and figure out, at times, you have to think about yourself, if I make this investment, are the odds in my favor that I will outperform from this point? Doesn't matter what the stock has done. Doesn't matter if Tesla has done amazingly well, or that NIO has like a lot of big investors investing in that company. Doesn't make any difference about that. You just have to think yourself, from this point, do I know something that everyone else doesn't know? And do I believe that I have a more than a 70% chance of this working out favorably? So it's quite difficult to be able to answer that. I didn't know that growth did very well. In 2010, yeah. So in last decade, definitely. So growth has done quite well in the past decade, and it's become very, very, very crowded. And I believe that within here, there is going to be some very, very interesting opportunities. Being able to pick those out successfully is very, very tricky. There's a lot of eyeballs competing for that, and that's why I'm kind of trying to stay quite humble. And I know that the value stocks are not doing well, but I still own them because I see it as dry powder, so that if there is some kind of value rotation that sometimes happens, the market changes sentiment very quickly, sometimes 7 days, and everything is out the window and it's a whole different dynamic. But I keep these kind of value stocks. The value stocks are not supposed to do as well over time as the growth stocks, at least for me as an investor, but they kind of just give me some dry powder that if there's a value rotation, I can exit those value stocks and I could position more of my capital into the growth names that I'm kind of following on my watch list, but the kind of the multiple is compressed quite significantly. So what are my two best growth and my best two value stocks? So I will tell you that, and keep in mind that a lot of people that will be watching this video, by the time you actually watch it, will be after the earnings season is finished next week. So everything that I say will kind of probably be egged on my face. The two best growth stocks that I like is Upstart and Fubu. So Upstart is basically a banking platform that helps you as the consumer get a loan approved. So in the US, if you haven't got a high enough FICO score, that's like a credit score, it's kind of difficult for a bank to validate you as the customer. So you use their kind of intermediary, Upstart's intermediate platform, and you kind of get approved for a loan. And with Upstart's platform, the default rate is approximately 0.4%. So for the bank, it makes a lot of sense for them to be able to pay Upstart a fee, because Upstart is pretty much guaranteeing that who they approve will not default on their loan. So there's actually a story that the CEO talks about, that the co-founder of the business was 23 and from Harvard and very well educated in finance and whatever, and very privileged background, but he couldn't get a loan that he wanted, and because he just didn't have enough of a credit rating. And with Upstart's business model, he would have been able to quantify, and the bank would be able to lend in that loan. And with other ways of getting a loan, if you want to borrow, let's say 50k from a bank, it might take 2 or 3 weeks of paperwork, and that will really delay you if you kind of want that cash right now. With Upstart, it's very timely. You kind of get it straight away. The other business that I really like is Fubu, and that's also going to report next week. So that's another stock that can go either way on the back. So if you look at this after next week's earnings season, you're kind of going to say, oh, Michael was wrong or Michael was right, or whatever. But it's just, it's one price target, and it can be very, very volatile. But Fubu business, I believe, is quite poorly misunderstood, because the profit margins right now are non-existent. But the idea is that you get the subscription business is approximately 85% of their business, and that's really just being able to get in touch with the consumer and getting the credit card details, and that's not supposed to be run as a profitable side of the segment. And then you got the advertising side of the segment, which is approximately 15% right now, and that's growing at approximately, I don't know how it's going to do in Q3 right now, but it was growing at 284% year over year in Q2. So if, as we've seen with Roku, that their RPU was up 40% or 45% year over year for the results just announced for Q3 about a few days ago. So if Fubu was also approximately up about 40% year over year on the pricing side, together with more subscriptions of about, let's say, 70% year over year, you're probably getting close to 130% growth on the advertising side. So that means that as we come to exit Q4, I believe that Fubu's advertising segment might account for 20% of the business, and that's growing with high margins of approximately 65%. So the business is transforming, and then you're going to be able to take that cash flow and invest it into its sports betting segment. So that's the kind of thesis. I don't know if it's going to work out. I'm kind of running out of time, so I'll just talk. The other two that I really like is Rent-A-Center. That's a value stock. That's one of the ones that I'm passionate about. They just reported results, and I felt that it was okay, the results, but the stock got punished quite significantly, and it was I think they fell about 18% on the back of their results, but they priced at approximately 12 times free cash flow, and they are growing at approximately 15%. So that's one of the businesses that I really like, Rent-A-Center. And finally, GoPro, which I already talked about earlier in the video. So can you talk about the dilution or share dilution in growth stocks? How to keep track of what happens in order to reassess. So when you look at the bottom, so anytime you open a press statement or the SEC filing on the 10Q or 10K, you can just type Control F number of shares outstanding, and you can see how they're growing the number of shares outstanding over time. So if the business is, let's say, the number of shares is growing at, let's say, 50% year over year, but the top line is only growing at, let's say, 30%, that means you're getting diluted out and they're not really getting a proportional amount of growth. On the other side of the equation, let's say that the number of shares outstanding is growing by 15%, but the top line is growing by, let's say, 50%, that will be very, very attractive. So that's, in software businesses, most of the management get paid in stock-based compensation, so that'll be a way for you to very quickly figure out whether the amount of shares that they're diluting you by is worthwhile thinking about. I hope that answers that question. Please let me know if you got any more questions, and I'm very excited to do this, and I'm so grateful that a lot of people kind of tuned in today. Please make sure to write me a question if you're kind of interested. You can write to me on Seeking Alpha, and you can just write a question beforehand so I can kind of give you some detailed answers here today. If there was anything else that you guys wanted to kind of talk about, let me know. Please just write me a question either now, if you want, in the next few seconds, or I'll just give it a second for anyone if anyone wants to write. But otherwise, I hope you guys have a very good earnings season, and just stick around. I'll see you next Friday at 9 a.m. Eastern time. Okay, thanks everyone. See you soon.